Let's roll up our sleeves and get to work and start building your financial plan. Now, I know some of you have been dreading this time. You're like, oh, this is the lesson. This is the part I don't want to do, working with my financial plan. You may not be really financially oriented, or you're a little bit worried about it. Don't worry. Even if you have been trying to avoid this, you can't avoid it any longer. And we're going to make it really easy for you. So I want to tell you, you don't need to know Excel. You don't need to go Google Sheets. You don't need to know how to work a spreadsheet. We've made it really easy. We're going to take you step by step through the process. Now, I want to quell your fears just a little bit. I know that going into this process, some of you are fearful. Maybe you don't have the knowledge, or you don't feel like you come from this background. It's really pretty simple to actually walk through this process. And I can't tell you how important it is that you get this right, because this is what all the investors are going to look at. This is what they're going to question you on. So I want not just you to understand how the financials are put together. I want you to understand the details around what the meaning is behind the numbers. Now, what we've done for you is we've actually created a series of spreadsheets that you can walk through step by step. We're going to walk through step by step. And even the most sophisticated investor will understand these financials with ease. So let's get started. Now, first what we do is we have 5 interconnected templates that actually work together to create the entire financial plan. I'm going to walk again step by step through this process. The first 3 worksheets are where you actually work with your financial data. This is where you input all your information. They're kind of like your playground. You can enter in different assumptions. You can see the impact of those to all of your financial statements. And then the last 2 templates that we have are what we call the statements of an income statement, or what we call a profit and loss statement, and a cash flow statement. 2 very important statements. Now, the good news is you don't have to touch those. You don't have to touch any of those. All the information that you input from the first 3 worksheets will flow right into the statements, and you'll get your financials out. So we're going to make it easy for you. Let's take a quick look at each. The first one is the revenue worksheet. And the revenue worksheet is where we calculate all the revenue coming into the business. Now, this is a very important one. Now, in the revenue worksheet, we have different models, and the different models match the type of business that you're in. So all we're going to do is we're going to match the type of business that you have with the model that we're going to use. And again, I'll guide you through this entire process. The next one is the staffing worksheet. This is where all of our employees and contractor costs are going to go in. Now, I like to separate this out from the overall expense worksheet. And the reason is because staffing is so important. Investors really want to know who you're going to have, when they're going to come on. And it's a pretty big expense for a lot of companies. So by pulling that out and really focusing in on that data, we can start to work with that data. The third worksheet is our expense worksheet. And this is where all the expenses that you're going to incur in the company go. And it's broken down by different expense categories. And these categories are very important, by the way. So we'll go through each one of those categories. The next one is the income statement, or also called the P&L, or profit and loss statement as well. And this reveals really important information about the operations of your business. This is probably the most important document. It's a standard, it's standard format. Therefore, every investor will understand exactly the terminology that's used on this. And most importantly, this also tells you your profit and loss, which is really important. And the final worksheet is your cash flow statement. And your cash flow statement just simply shows your inflows and outflows of cash going in and out of the company. Pretty simple concept. It's actually a fairly simple spreadsheet, but it reveals a lot of really important information, because you never want to run out of cash when you're running a business. The cash flow statement also looks at any bank loans or other investments that are coming into the business. So we can see the interplay between the cash that's being generated by the business and any investments that come into the business as well, to get our total cash balance each and every month. So there's a few things that I want you to know before we get started. First thing is, I like to do financials that go out about 3 years. That's kind of the industry standard. Now, that works for most businesses. You don't want to go out a year. You don't want to do financials for just a year or even 2 years. Most investors are going to expect 3 years for your financials. Now, there are some industries that might actually even have to go out further, 5, 6, 7 years. Like if you're in the wine business, as an example, it takes 7 to 10 years before that business will really take off. So you might need to extend that. The model is flexible enough to extend it as far as you want. That's not a problem at all. When you open the model is in protected mode. Now, protected mode basically means you can't mess anything up. This is the good thing. You can only input in the areas that are available to you to input. So you can't mess up any of the calculations or anything. So do whatever you want in these spreadsheets as long as you're in protected mode. But for you advanced people out there, for you spreadsheet wizards out there, I also have an unprotected mode, which is basically just you open up with a password. The password is actually in the variables tab. We'll show you exactly where it's at. And you can then do anything you want with these spreadsheets, but you have to be careful and you have to know Excel. But I've given you some guidelines, and we're going to be giving some additional guidelines to make it really easy in order to add or modify the spreadsheet if you want to. There's no reason that you have to modify the spreadsheet, however. You should be able to get a great set of financials out with just what we've delivered to you. The worksheets are color-coded, allowing you to do certain things. So the first area is the light blue area. The light blue area is your playground. This is where you're going to type in all your information. Anytime you see light blue, you can actually input titles, descriptions, numbers, whatever you'd like to do. So that's the area. You can't hurt anything if you input something in a light blue area. You'll be able to see it. No errors will pop up. Your data may be wrong, so you may need to adjust it, but that's easy to do. Now the yellow line, you're going to see this yellow line in some of the spreadsheets, and basically only do you need to worry about this yellow line if you're in unprotected mode, meaning that you can edit anywhere. And all I want to advise you is that you want to, anytime you insert a line, you want to insert above the yellow line. That's all. It's just a little quirk in Excel that if you insert below the yellow line, it will throw off the calculations, meaning the additions won't actually add up properly. Now there's a gray area as well. There's only a couple of gray areas in the entire spreadsheet, and essentially what they do, also in unprotected mode, means you might have to modify an equation, a very simple equation, like an addition equation, this plus this plus this. Very simple to do. However, there's only really one or two areas that you have to worry about in this. And if you see a black box, which there isn't really, there's only one black box as of right now in the spreadsheet, so that just means there's no data input. Don't input data there. Let's get started with the variables tab. And the variables tab allows you to change variables and assumptions that are embedded in the worksheets. And so you can customize things like the name of the company, the start date of the financials, which we'll go through because that's a very important thing. Certain titles and names that we've given you the opportunity to customize to your individual business. Enter other variables and assumptions that you need for some specific calculations like tax calculations and things like that. Now we're ready for our first worksheet, which is our revenue worksheet. And this is where we're going to forecast revenue. And I'm going to actually teach you how to forecast revenue in this process. It's a very important thing to do. This anchors your entire business model, is understanding and making sure that you understand and have very accurate forecasts. The better your forecast is, the better your overall financials are going to be. So your revenue forecast is very important. Now, I will say it's one of the harder things to do, though, because you're actually trying to predict the future. So what we have to do is use our best estimates, or I'll call guesstimating, is certainly okay here as you start to ramp your revenue. It's okay to do that, but what I would rather you do is justify every line of revenue that you have and back it up with data. The more backup you have here, the more facts that you have here, the more justification you have for what you're putting on the paper and in the spreadsheet is critically important, because you're going to have that when you're talking to investors. So keep that in mind. So good revenue forecasts will actually help you planning all your cash flows for the business. And I will tell you, cash flow is probably the most important thing. I have seen more businesses go out of business because of cash flow problems, not necessarily success. They could be wildly successful, yet they run out of cash. In fact, because a growing business actually requires cash to keep it going. So the more you're growing, the more cash you need. This is why cash is so important. And the revenue forecast is the beginning of that entire thing, because it trickles down through all of your entire business, right? So that's important. Now, this also tells you when you can spend money, how much money you can spend, or how much money you need to scale the business. And this is important because as you're growing, you're going to need to know, well, what are other things that I need to anticipate? So this is the foundation of that, because as you grow the business, it informs all the other expense that you have, including your staff, additional production capabilities, expansion of stores. All of that is the foundation of all of that is within your revenue forecast. Now, your revenue forecast will also take into account seasonal fluctuations in your business. So if you have a cyclical business or a seasonal business, this is very important because you need to also adjust your revenue, your operations, and other things according to the seasonal fluctuations that you have. You might need to bring on staff during busy seasons, as an example. That all has to be reflected into your financials. And again, where does it start? It starts with the revenue. If the revenue is seasonal, then the rest of the model also has to be seasonal as well to take that into account. It also creates an invaluable benchmark for your overall business. So these are some of the great things that a revenue forecast will do. I got to tell you, you'll run your business literally every month. You'll be looking at your revenue forecast. You'll be revising your revenue forecast as you go through. So what we're doing here is we're setting the foundation of the business in the business plan so that when you actually start the business, you can then use these documents and continue using them into your operations of your business. There's some things that I want you to pay special attention to when you're trying to figure out the most important thing, which what drives your revenue. So I want to make sure you ask the question, what is driving my revenue? So it could be things like number of stores or number of new stores that I'm opening, number of clients that I have, the number of subscriptions or the increase in subscriptions that I get each and every month. Could be hourly billing, like the number of consultants that I have and how much are they billing, or what is their utilization rate, which is also another very important variable. So maybe I'm utilizing my staff at 50% and only billing them out at 50% when you should be at 80%. These are all things that will drive revenue either up or down. Also, your direct marketing, any online or offline, digital or offline things that you do in your marketing to acquire customers. So what's driving your customer acquisition? Because directly, that could also impact revenue greatly. So one of the most important things you can do when you're doing your revenue forecast is scaling your revenue. How do you scale your revenue forecast? And we want to go through that real quick because you want to use the best data that you possibly can to determine what do I do in month 1, what do I do in month 2, what do I do in month 3, and what do I do in year 2 and year 3 as well. That's what I mean by scaling your revenue model. Now, it's important. This is an area that I get a lot of questions on, so I want to make sure that we're really clear in terms of how do we do that. The first thing that I like to do is I actually just like to use what data do I have out there, the best data that I have to justify how I'm going to scale and grow the business. What's driving it? Did I hire more salespeople? Am I doing more marketing? Did I come out with a product release? There are things that actually drive the scale of your revenue. Otherwise, you'd just be flat or you would go down, right? So you want to make sure you tie your revenue forecast to specific activities in the business, because when an investor comes to you and says, why did your revenue all of a sudden go up? You have to have an answer for him or her, and you have to be able to justify that. So as an example, I add a new salesperson and they can generate $500,000 in new sales per year. That's a driver. So if I hire 3 of them, they can generate $1.5 million of revenue. Those are things that scale the business. There's a justification behind what you're doing. Now, another area is maybe I have a big marketing push, and on every activity that I do, I generate 50 new customers a month, as an example, because I'm advertising or I've got my new website up or what have you. So you want to take those things into account as well. This is what I mean by justifying your financial model. You can get down to a very granular level of detail and justification, but just at a high level, you can start to use this as you scale the business, because what you're going to need to do is every month, you're going to need to either figure out how is my business growing, how do I expect it to grow, and again, what is driving that growth, which is really, really important. Now, you can do some of this work outside the model and then bring it into the model if you like. So that means you can do these calculations in another spreadsheet or what have you, and then you can just input them into the financial model that we provided for you as well. Or you can do some of that or all of it right in the model as well. It's your choice in terms of how you want to do that. Some businesses are very complex and they actually require fairly complicated models in order to forecast revenue. So again, you can do that outside the model and bring it in if you'd like. No matter what techniques you decide to use to forecast revenue, I recommend one thing that's so important, and it's really hard for entrepreneurs to get this point, which is gradually scale your business and your revenue forecast. The worst thing that you can do is all of a sudden hockey stick up, and your entire financial model is based on that hockey stick, or you're growing too fast. You have to remember something, that you can only absorb so much growth as a growing business. There's only so much new business and new revenue that you can absorb. Even if you have a highly scalable business, it requires infrastructure and operational excellence in order to really sustain that growth. Otherwise, you kind of inflate things, you build a house of cards, and then you collapse. And I've seen business after business do that as well. So kind of try to avoid big spikes in revenue. Big spikes can be a flag for investors, so you want to make sure that if you do have them, that you can explain them very well. Also, make sure that you take into account seasonality into the business as well, because seasonality doesn't just mean holiday. There are certain industries that order during certain times of the year, and that revenue then might actually even come in bulk in a certain time of the year. So we need to keep that in mind as well. So it's not just the seasonality of the business, but when businesses are ordering and when customers are actually buying. So keep that in mind as well. So as I mentioned earlier, you've got 4 different pricing models that you can use in our worksheets here. So let's say that you have a business that has many different products and many different price points. And a lot of businesses are like that. A lot of retail businesses where they carry literally tens of thousands of SKUs and you're like, how do I forecast revenue on every SKU? Well, you don't. In fact, there are techniques that I'm going to give you 2 techniques in which to potentially use for your business. One is called grouping and tiering. Essentially what we're going to do is we're going to group things by individual pricing tiers, and then we're going to estimate revenue based on those pricing tiers. Let me give you an example. Let's say that I'm going to sell 100 units, and it could be 100 units of anything. And the average price is between $4 and $6. So I might actually put $5 as the price that I'm going to use to calculate. I might sell 200 units at $7, and it's anything around that $7 number. And then I'm going to sell 300 units at $10, and it's anything between maybe $9 and $11 or $9 and $12, and so on and so forth. So what you're doing is you're creating revenue groups or tiers based on the pricing, and then you can estimate, well, how many am I going to sell in this group? And how am I going to sell in this group? And how many am I going to sell in this group? That becomes very important. Now, I wouldn't recommend creating so many tiers and so many categories that it just blows up the model. Try to keep it down to where somebody can understand it. Maybe it's 4, 5, 6, maybe 7 tiers. But if you have too many tiers, it kind of just deflates what you just did. Now, I've got another technique. If in fact you have to create that many tiers, use this technique, which is called the AOV technique. What does AOV stand for? It actually stands for average order value. And average order value basically across your entire business. So let me take an example. Let's say that my average order value is $100 across my entire business. All you then have to do is say, how many orders am I going to get per month at the average order value of $100. And by the way, you can scale the average order value up as your business grows. You might have more products, more SKUs, more things for people to buy. So your average order value goes up. You can forecast that, but it does everything at the aggregate level. Let me give an example here. Zappos, right? Zappos shoes, right? So their average order value is $137 and they sell 10,000 units or 10,000 shoes a month. So they have revenue of $1.3 million worth of shoes per that month. And then you start to do your estimates based on that. So do you see how that works? It's actually pretty easy technique to do. It abstracts your entire business to really a couple of numbers, and then you can just scale those numbers accordingly. Billing-based pricing. And billing-based pricing is basically ideal for professional services organizations, for any type of business like lawyers, chiropractors, consultants, digital agencies, anybody that charges on a usage-based billing. So like an hourly billing if you're charging for employees, or on a per minute, or other types of usage-based. So it can actually be used not just for professional services organizations, but anything that's usage-based, like you charge on per gallon or per foot on whatever it might be, whatever unit measurement you might be using, or usage that you might be using per minute, as an example, which some businesses work on as well, you can use this model for. So also, you might want to use this model if you're a product business, but you actually have a services add-on to your business, like implementation fees or maintenance fees, other types of things. So you have your base product business, which is actually a different revenue model, and then you have your services line item, which you use the billing-based billing-based model for as well. So what do you need to do this model? Well, basically, you just need to know the number of hours of billing hours per month, or any unit of measure, again, and you need to know the rate. What rate am I billing this at, or what rate am I charging this at? And that's how it works. We've also created an advanced model that takes into account the number of staff that you're actually going to have, and then it takes into account what's called their utilization rate. And so it's another way of calculating a billing-based business is based on utilization rate and the number of staff per position or per bill rate. And so we'll go into this and we'll take a look at that a little bit later, but it does allow for more flexibility in the business. Let's take a look at an example now. Let's say I have a digital agency and I've got 4 main categories of people. So I have my SEO expert, my strategist, my senior strategist, and my designer. And they're all billed at different rates. I might bill my SEO expert at $100 an hour, where I bill my designer at $150 and my senior strategist, let's say, at $200 an hour. Now, there are 2 different ways that you can do that. One is you can just take each one of those positions, multiply it by the number of hours and the amount of time that they're going to actually work, right? And then you'll get your revenue forecast that way. You can also use another method if you've got even more positions. Instead of line iteming out every position, especially if you have a lot of different positions and they all have different rates, you can use that technique that I talked about earlier, which is the average order value method. And that technique will allow you basically to create what's called a blended rate. So what you're doing is you're just averaging across all the different positions, you're averaging a rate. It's kind of your general bill rate, if you will. And you take that and you use it across all the different employees that you have that you're billing for. It's a very simple technique. I actually use it. Customers like blended rates, by the way, so you can even charge this to customers. But even if you don't charge it to the customer that way, you can use it in your financials. It's a very convenient and easy way to do this. Our next model is what we call the subscription model or the reoccurring revenue model. This is actually my personal favorite. I love businesses that have a reoccurring nature to them. So if you've got a reoccurring nature to your business, you're in good shape. So this is any subscription business, any membership business, or anything that has a reoccurring nature to it, you can use this model for as well. Even if a component of your business has a reoccurring, like a maintenance fee or an ongoing maintenance fee, you can use this model for that as well, while you might be using a unit-based model for all your products, as an example. So some of the businesses that this really works well in is SaaS-based businesses, subscription, or we call software as a service. Many software businesses in general, this works great for. Service businesses with retainers, or a productized service that recurs either monthly or annually. This also works good in addition to just like subscription businesses and other things. Again, anything that reoccurs is perfect with this. What will you need to know in order to use this model? Well, first you need to know either the monthly or yearly units that you're going to sell that actually reoccur by subscription type. I like to break it down by subscription type because they're each going to have different pricing. So you also need to know the price of each subscription type. The next thing you need to know is the attrition or the churn rate. This is very, very important, by the way. This is the percentage of customers that will cancel their subscription on any given month or year, depending on the term of the subscription. And you have to take this into account. A lot of people forget this. They say, oh, well, nobody's ever going to cancel my subscription. Well, I got to tell you, yes, they will. And this has to be factored into your overall revenue model because you're going to lose customers. And you want to make sure that you're adding customers at a higher rate than you lose them, because you will lose customers as well. You can vary this rate by the type of business, which basically means that some businesses will actually churn customers more than other businesses as well. The average range is anywhere between 2 and 10% per month. Now, I will tell you that some businesses run even lower than that. I'm giving you general averages. Every industry that has this type of recurring revenue model, you generally has statistics around that. So again, go out and research this. You will find information. And it's very important that you get this number correct as well. So, some things to consider. First of all, what's driving the increase or decrease in subscriptions or memberships? Is it marketing? Is it the sales efforts that you're going after? Is it scale? Take those into account. You want to make sure you understand the drivers behind what's increasing it. A lot of times in these subscription businesses, something to do with sales or marketing that's pushing this business forward. Or what's the decrease, which could be things that you're pulling back on as well. Or maybe you're losing customers faster than you're getting them. All of these things in this model. This model is a little bit more complex, so you got to take more things into account. How is the subscription growing? What does the trend look like? And again, also ask your question, what is my churn rate? Is my churn rate decreasing or increasing with the scale? That's also very important. So as your business gets bigger, your actual churn rate might actually go down. So keep that in mind. Also, credit card expiration. So if you're a B2C business and you're accepting credit cards as a way of rebilling customers every month or every year, you've got to make sure you take into account expiration dates and payment issues that will inevitably come up in that business as well. Also, I'd like you to look at how you can either upsell or upgrade or downgrade a subscription. So will customers actually reduce the subscription level they're at? Because in a lot of cases, you will offer different tiers of subscription. Or will they upgrade? Because that's a great way to get customers to increase their overall value to you. And then you also have to allow for returns. Believe it or not, you can get returns in this business as well. Somebody tries out your service for a month, they don't like it, you give them their money back. That's pretty important in a subscription business because you don't want to damage your reputation. Reputation is everything. Now, let me give you a couple examples. These are just examples of very well-known companies. First of all, Netflix. 130 million subscribers and a 9% attrition per year rate, which is, by the way, very low. That's like less than 1% a month. Amazon Prime, we all know Amazon Prime, over 100 million subscribers and a less than 10% churn rate as well in that business. Now, those are very mature businesses and they're very large. That's why those churn rates are so low. As you're getting your business started, your churn rates probably will be up a little bit higher. And our fourth model is called the revenue no calculation model. And essentially what it does is that if you didn't fit into any of the other models, you're like, this didn't work for me and that doesn't work for me and that's not my business, then you can use this. Basically, all you do is input your revenue by month into the model for every revenue stream that you have. So it's a free-formed way of getting revenue into the model. Now, a lot of people, what they'll do is they'll calculate their revenue offline in varying spreadsheets or other models that they have, and then they can bring that data and use the revenue no calculation model to actually just input the revenue in. So it's a free-form way to do whatever you want. Some things to consider if you're using this model, and you're basically saying, you know what, I don't want to use all these other fancy models, I just want to use this model, and I just want to plug numbers in, right? So essentially what you're doing is you're guesstimating. This is kind of the default way of doing it. If there's nothing else that applies and you just want to get numbers into the model and you're going to guesstimate them, I want to give you some advice. First thing is be conservative rather than aggressive. Especially the more that you guesstimate, the more that you're away from the data that actually drives the business and the revenue, the more you want to be conservative. Don't go crazy here because this will get into so much trouble. I know as entrepreneurs, we are all optimistic. I am the quintessential entrepreneur, optimistic person. And I just want to say everything's great, but everything is not always great. So I want to make sure that you're very careful here. So qualify as much information as you can because you're going to get asked about it. When predicting your growth, avoid any hockey sticks. That's that jump in revenue. That's what a hockey stick is. It's all of a sudden you're cruising along and then all of a sudden your revenue jumps up. And if it does jump up like that, make sure that you explain it. I also want you to be thinking about just percentage increases, gradual increases in your revenue. Might be anywhere between like 2% a month or 20% a year. Show that increases, but increment slowly. And that's a lot of times how I forecast as well. Sometimes I'm just guesstimating, which is okay. And I'm just kind of incrementing my revenue slowly each month, going up, going up, going up. And then all of a sudden I have a really nice model and it flows really well. Another thing I want you to take a look at is milestones. When you're forecasting revenue, and even if you're just guesstimating, when you're forecasting revenue, I want to make sure you look at milestones in the business. As I mentioned earlier, things like product releases, key marketing events, maybe some staff hires. I bring on a new strategist. I bring on a new consultant. Those are important. I maybe add a new salesperson. Add a new salesperson. That salesperson better produce, right? Maybe I add a distributor, or I open up a new store, or maybe I add a product line. All of these things are important drivers to how you're thinking about that revenue. So even if you're just plotting numbers into the model, but you're doing it intelligently, I don't want you just to throw numbers into the model and ignore it, say it's not that important. This is critical. So think in your mind what's going on in your business, when it's going on, and plot that line. I want a nice, slow, gradual line of increase. And then if you add a new product line, sure, you can get a bump. You add a new staff member, yeah, start to assume their utilization is lower at the beginning, but then they get up to full speed. Factor all that stuff in. Don't assume 100% success every time you do something, because that's not how reality works. Now, a question that I get asked all the time is, when should I count my revenue? When does revenue actually count as revenue? Now, I don't want to get into a bunch of accounting methods and how it all works, but there are some general practices that I want to make sure that you keep in mind. And please make sure you keep this in mind. This is a very important rule. Revenue is typically counted when you invoice a customer. Now, depending on the type of business that you have, sometimes you invoice the customer and actually create a sale and collect the cash all at the same time. So that's your revenue. That's pretty easy. But a lot of businesses actually have it spread out. You actually sell the customer at one point and you haven't invoiced anybody. And then 3 months later, you invoice the customer because you've done the work. So that's the time you count revenue. And then it takes another 30, 60, or 90 days for the customer to pay. That's actually cash. So the revenue is counted right in the middle there. You can't count it when you book it. And a booking is essentially when you make the sale. When you make the sale, but you actually have to still deliver the product or service that you're doing, then you can't count that as revenue. So the fact that you sell it or get a signed contract doesn't automatically go into revenue. But if you invoice it, then it does go into revenue. Let me give you an example real quick. Let's say I sign a big deal. It's $100,000, but I'm going to deliver it over the next 6 months. And I can actually invoice the customer every month for the next 6 months. So your revenue is actually divided by 6. It's actually invoiced. Every month, you get to count 1/6 of that revenue or that contract that you have. That's how we account for revenue. That's how we calculate revenue. And I know people get tripped up with this all the time. So a lot of times people say, hey, when I get the cash is when I count it. No, actually, you count revenue beforehand because you're pretty much guaranteed to get that cash, unless you have a huge bad debt issue, which then that's a different problem that we can tackle. I really hope you found this video valuable. Now, the best conversations start with you, so make sure that you leave a comment, a question, or maybe a takeaway that you got from watching this video. And you're not only going to help yourself, but other entrepreneurs as well. We're adding new videos all the time, so make sure you subscribe to our channel and get access to all this great content that will help you build your business. Oh yeah, make sure that you also share this video with a friend because they can benefit from it too. Be sure to visit entrepreneurnow.com to subscribe to our newsletter, Launch. Now, you'll get exclusive access to articles, free videos, interviews with world-class entrepreneurs, access to our live events, and insider tips that you can't get anywhere else. Thank you so much for watching. We'll see you next time on Entrepreneur Now TV. If you want help with making your business a huge success, then go to entrepreneurnow.com and learn from successful entrepreneurs that will take you step by step through the process of creating and growing your business. Whether you need help with things like a business or financial plan, your overall business strategy, tactical marketing and sales execution, or obtaining financing, we will be right there every step of the way to help you. Every entrepreneur I know benefits from having someone right there as they launch and grow their business. So we provide one-on-one and group mentoring to all our members. In addition, our members get access to on-demand videos, all our live events, financial planning tools, and a library of worksheets and resources at their fingertips. And the best part of all is you're part of a community of entrepreneurs that learn and inspire each other. So now is the time for you to take action. Go to entrepreneurnow.com and join us today. Minus $15 is my cost, divided by $50 gives me a 70% markup. So you start to understand how that calculation can work. Because there are so many different selling models, I want to make sure that you understand the landscape out there and how it all fits together.